Close your eyes and imagine a black screen. Now ask yourself a single, simple question. Do you know exactly how much money is in your bank account right at this very moment? Most people would say yes, or at least they would have a very good idea. They check their mobile applications, they look at their monthly statements, and they place their complete trust in the numbers they see on the screen. But what if those numbers were lying to you? What if for years, a tiny fraction of your hard-earned wealth was being shaved off, cent by cent and dollar by dollar, without you ever receiving a single notification or a warning alert? This is not a conspiracy theory or a glitch in some computer program. This is the cold reality of a massive financial settlement involving one of the largest and most powerful banking institutions in the United States. Bank of America has agreed to a $2,250,000 settlement to resolve legal claims that it unfairly charged its customers duplicate fees. These were not just any standard fees. They were specific, predatory charges tied to balance inquiries made at automated teller machines located inside 7-Eleven stores across the country. The mechanism behind this was as simple as it was devastatingly effective for the bank. Between the years of 2018 and 2021, customers who used these out-of-network machines were hit with a hidden double whammy. Imagine you walk into a 7-Eleven on a busy Tuesday afternoon. You want to see if your paycheck has cleared or if you have enough money to buy a quick lunch. You put your card into the machine, select the option for a balance inquiry, and wait for the receipt to print. In that brief moment, the system triggered a fee. But here is where the concept of fee layering began. For a single request for information, the bank often charged not one, but two separate fees for that one inquiry. It was a mirror image of a transaction, a ghost charge that followed the real one, like a shadow. To the average person, a fee of $2, or perhaps $2.50, might look like a standard out-of-network penalty. You might grumble about the cost of convenience, but you ultimately accept it as a normal part of banking. You would never suspect that tucked right behind it was another identical charge, effectively doubling the price of a simple glance at your own money. This was not an isolated incident or a rare mistake. This happened millions of times over a 3-year window, stretching from May 1st, 2018 to November 16th, 2021. Think about the sheer scale of that operation. When a massive corporation like Bank of America extracts an extra $2 or $3 from millions of individual transactions, it creates a mountain of capital built on the backs of unsuspecting people. For the bank, it was a silent windfall. For the customer, it was a leak in their financial boat that they did not even know existed. Because the amounts were so small, they fell beneath the radar of even the most diligent and careful budgeters. Most people do not audit every single line of their monthly statement with a magnifying glass, and the banks are well aware of this. They rely on the fact that your time is worth more than the effort it takes to dispute a tiny $2 charge. But over time, across millions of customers, these microtransactions add up to millions of dollars. Consider the story of the unaware customer. This is someone who perhaps had an account with Bank of America several years ago. Maybe they moved to a different state, switched to a local credit union, or simply closed the account because they wanted a fresh start. Today, they likely have not thought about their old bank in a very long time. They assume their relationship with that institution ended the moment they shredded their old debit card and signed the final papers. Little do they know that bank still owes them money. They are a ghost in the system, a claimant with a legal right to a portion of that $2 million settlement fund. But there is a major catch in this situation. While the bank may automatically credit the accounts of current customers who were affected by these fees, former customers are being left in the dark. They will not receive a phone call from a manager. They will not get a friendly text message reminder. They are expected to find out this information on their own, to navigate the complex bureaucracy, and to demand what is rightfully theirs before the clock runs out on the legal window. The clock is indeed ticking, and it is moving faster than most people realize. There is a hard deadline of June 29th, 2026. If you do not file your official claim by that date, your share of that money vanishes forever. It will be absorbed back into the corporate machine or lost to the winds of legal finality. This creates an incredible sense of urgency for anyone who held an account during those critical years of 2018 through 2021. It raises a haunting question about the fundamental nature of our financial systems. If this double charging happened at 7-Eleven locations for something as simple as a balance inquiry, where else is it happening right now? How many other transactions on your statements, past or present, were actually double charged under the guise of a single service? Before we continue, subscribe to the channel and tell us in the comments where you are watching from. The deeper we dig into these records, the more we realize that the unaware customer is not just one specific person. It could be almost any of us. We are standing at the edge of a much larger revelation about how modern banking automation is designed to stack costs against the very people it is supposed to serve. The question is not just about getting your $2 back. It is about understanding how the system was allowed to fail for 3 years straight, without anyone stopping it. To understand if you are one of the millions caught in this financial net, you must first look at the calendar and pinpoint your movements during a very specific window of time. The period in question begins on May 1st, 2018, and stretches all the way to November 16th, 2021. During these 42 months, if you used a Bank of America debit card or a Merrill Lynch card to check your balance at a 7-Eleven automated teller machine, you were likely a victim of this duplicate fee structure. It did not matter if you were in a bustling city center or a quiet suburban corner. If that machine was not owned by Bank of America and it sat within the walls of a 7-Eleven, the trap was set. For every single time you hit the button to view your balance, the bank's automated systems were triggered to look for an out-of-network event. But instead of seeing one event, the code essentially saw double. This is where the narrative splits into two very different realities. For those who are still current customers of Bank of America, the path to restitution is relatively paved. The bank has the data, the account numbers are active, and the settlement suggests that these individuals may see credits appearing on their statements without having to lift a single finger. However, the story is tragically different for the unaware customer. This is the individual who closed their account in 2019 or 2022 and moved on with their life. For them, the bank has become a closed book. Because they are no longer in the active database, the institution is under no obligation to hunt them down and hand over a check. This creates what consumer advocates call a manual bureaucratic hurdle. The bank keeps the money by default, and it is only released if the former customer discovers the truth and initiates a complex claim process. If you suspect you are one of these forgotten claimants, your journey starts at a very specific digital gateway. You must visit the official website designated for this legal action, which is oonfeesettlement.com. Navigating this site is the first step in reclaiming what was silently siphoned away. Once there, you will find yourself interacting with the Kroll Settlement Administration. They are the third-party neutral party appointed by the court to manage the millions of dollars currently sitting in escrow. Their role is critical because they act as the gatekeeper, ensuring that the bank does not simply keep the unclaimed funds for itself. When you enter your information into their system, you are not just filling out a form. You are asserting your legal rights against a multi-billion-dollar entity that has already profited from your silence. The challenge for many former customers is the lack of physical records. If you closed your account 5 years ago, you likely do not have a stack of paper bank statements from 2018 sitting in your desk drawer. You might not remember exactly which 7-Eleven you visited on a random Tuesday afternoon. This is the documentation trap that often discourages people from seeking justice. However, The Kroll Settlement Administration has access to the master records provided during the discovery phase of the lawsuit. Even if you do not have your old account number memorized, you can often provide your social security number or previous address to verify your identity within their database. The system is designed to find you, but only if you provide the spark to start the search. It is a digital treasure hunt where the prize is your own money, returned to you years after it was taken. This brings us to a significant pivot in our story. We must move away from the question of how to get the money and start asking why the system allowed this to happen for 3 entire years. How does a massive financial institution, equipped with the most advanced algorithms and regulatory compliance departments in the world, fail to notice that it is double charging millions of people for the exact same service? The answer lies in the regulatory gap. In the world of high-frequency banking, oversight often focuses on large-scale fraud or massive systemic collapses. Small, incremental fees of $2 or $3 are frequently ignored by federal regulators because they do not threaten the stability of the economy. But for the individual, these fees represent a breach of trust. The standard ATM user might assume that there is a digital watchman standing over every transaction, ensuring that every cent is accounted for. In reality, the watchman is often an automated script that prioritizes profit and efficiency over granular accuracy. When the fee layering mechanism was initiated, it likely began as a small coding error or a misunderstood directive between the bank and the out-of-network providers. Because it generated revenue rather than losing it, there was no internal alarm system to shut it down. It became a financial ghost, an invisible force that extracted wealth from the pockets of students, workers, and retirees without ever leaving a trace on their daily radar. Discovering this error years after the fact creates a strange sense of financial vertigo. It makes you wonder what else is hiding in the fine print of your current agreements. As the market observer would point out, these legal settlements are often the only way to force a change in corporate behavior. Without the threat of a $2 million payout, there would be very little incentive for a bank to audit its own fee structures for these types of overlaps. The settlement is not just about the money, it is a rare moment of transparency in a world that is usually opaque. But as we peel back the layers of the Bank of America case, a chilling realization begins to dawn. This particular settlement only covers one specific type of transaction at one specific retail chain. It does not account for the thousands of other out-of-network providers across the globe. Is it possible that this was not a localized glitch, but rather a symptom of a much broader strategy used by many different institutions? There are hints appearing in other legal filings that indicate Bank of America might not be the only titan utilizing these fee-layering tactics to pad their bottom line. The ghost fees we are seeing today may only be the beginning of a much larger haunting that spans the entire banking industry. As we move toward the final deadline of June 29, 2026, the pressure is mounting for every consumer to become their own auditor, because the system clearly is not doing it for them. The concept of fee layering is a strategic stacking of microtransactions designed to fly beneath the radar of the average consumer. To the automated systems of a massive institution like Bank of America, these are not errors. They are predictable outcomes of a system programmed to maximize every single interaction a customer has with an out-of-network machine. When you stood in that 7-Eleven and asked to see your balance, the algorithm did not just see a request for information. It saw an opportunity to trigger multiple service fees simultaneously. This is the heart of the fee layering mechanism, a digital architecture where one action spawns 2 charges, effectively doubling the profit margin on a transaction that costs the bank almost nothing to process. These are not the result of a single corrupt employee or a mustache-twirling villain in a boardroom. Instead, they are the byproduct of systemic incentives that prioritize automated profit-seeking over consumer clarity. When banking code is written, it is optimized for revenue. If a glitch occurs that costs the bank money, it is patched within hours. If a glitch occurs that generates millions of dollars in duplicate fees, it often remains unaddressed for years. This creates an environment where the bank benefits from its own technical complexity. The market observer looks at these events and sees a clear pattern. It is a world where the burden of accuracy is shifted from the multi-billion-dollar institution to the individual person who is just trying to check their rent balance on a rainy Tuesday evening. For the unaware customer who has since closed their account, the recovery requires a focused action plan. You cannot wait for the bank to find you. You must take the initiative before the clock runs out on June 29th, 2026. This date is your final opportunity to submit a claim through the official website, o1feesettlement.com. When you visit the site, you will interact with the Kroll Settlement Administration. They are tasked with auditing records from May 1st, 2018 to November 16th, 2021. Even without paper statements, you can use the digital portal to search for your previous status. The system relies on the fact that most people will find this process too tedious. By completing the claim, you are reclaiming your power and refusing to let those hidden fees stay in the bank's vault. While the settlement focuses on the past, the standard ATM user must look toward the future. This case serves as a lesson in financial self-defense. To protect yourself from current fee-layering tactics, you must become your own auditor. When you review your monthly statements, do not just look at the final balance. Look for out-of-network anomalies. If you see a fee for a withdrawal and a separate fee for a balance inquiry during the same visit, you are witnessing the same mechanism that led to this settlement. Many banks still utilize these overlapping charges, hoping the small amounts will be ignored. Use in-network machines whenever possible, or utilize mobile banking apps that provide balance information for free. Every time you avoid an out-of-network fee, you are starving the automated profit engine that thrives on your convenience. The legal community is watching the final hearing on August 21st, 2026. This hearing will be a bellwether for consumer protection law. The judge will evaluate the fairness of the $2,250,000 settlement and determine if the Kroll Settlement Administration has done enough to reach those affected. The market observer notes that if the turnout of claimants is low, it tells the banking industry they can continue to implement complex fee structures. This is why your claim matters. It proves consumers are paying attention and that corporate negligence is rising. This saga reinforces a hard truth known by those with insider knowledge. The system is designed to operate on the silence of the majority. It assumes you are too busy or overwhelmed by jargon to notice when a few dollars go missing. The bank's greatest asset is the collective distraction of its customer base. However, once you understand how money moves without notice, you gain a level of financial literacy more valuable than the settlement check. You begin to see patterns and systemic gaps that allow these ghost fees to exist. The resolution of this case provides a rare sense of empowerment. It is a reminder that while these institutions are massive, they are not untouchable. By recovering these funds, you are participating in a movement toward transparency. You are no longer the unaware customer. You are an informed participant in a financial system forced to treat users with respect. This recovery process is the final step in closing a chapter of exploitation that lasted for over 3 years. As we look toward the horizon, the fight for financial clarity continues. This investigation into Bank of America is just the beginning. In our next report, we will dive deep into the world of credit cards to uncover the ghost fees haunting millions of cardholders. These hidden charges often appear as legitimate adjustments, but reveal the same patterns of fee layering. To stay informed and protect your hard-earned money, make sure to subscribe. Knowledge is the only shield against a system designed to extract wealth in silence.